Hey everyone, Dave here. Welcome to episode 62 of the Pocket Mastermind podcast. On today's episode, I am talking about creating financial freedom through real estate investing with Lane Kawaoka. Lane took his earnings from his job as a civil engineer and through saving and investing managed to build up a portfolio of real estate, and now he works with high net worth individuals, sophisticated individuals to invest primarily in large-scale products like apartment blocks and that kind of thing. So it's a really interesting conversation for anyone who's interested in getting into real estate or wants to create financial freedom for themselves, interested in passive income. This one's definitely for you. So hope you enjoy it. If you do, please remember to share with your friends, hit the subscribe, make sure you're getting notified whenever there's a new episode, and also like and do all of that good stuff. It really helps me. Thank you very much. Have you ever questioned why it is that some people seem to have everything they could ever wish for? Health, wealth, love and happiness, but others seem to lack all of these things. Why is it that a small minority manage to achieve greatness, but the vast majority fail to reach even beyond mediocrity? What are this small minority doing differently to everybody else? It can't just be down to circumstance. Billionaires rise out of poverty. Those questions have been in my head my whole life. And a couple of years ago, I decided to stop wondering and start searching for the answers so that I could help more people achieve greatness in their own lives. So join me and follow along as I uncover the secrets of the minority that the majority aren't taught so that you can apply them to your own life to achieve your own greatness and live the life you want and deserve. My name is David Bell and welcome to Pocket Mastermind. Lane, welcome to Pocket Mastermind. Thank you very much for joining me today. How are things with you?
It is good. We've got the phones off, and let's help out your folks here.
Yeah. So we're going to talk today about creating a passive income, passive cash flow. And I guess the best place to start with that conversation is really your own journey, your own experience going from engineer to get into a place where you were able to create that passive cash flow.
Yeah, so I graduated college back in 2007, and up to that point I was just like anybody else following that linear path. I go to school, work hard, study hard, get a job, work at that job for 50, 60 years, maybe retire, right?
Keel over and die, yeah.
Invest in the retirement accounts, mutual funds, all that garbage. I took a pivot off of that path when I bought a house to live in, which I don't necessarily think is a good idea these days.
Mm-hmm.
I think you should invest your money instead. But that got me started. I started to rent it out because I was never at home. I was traveling all the time for work, as a new guy always is.
Mm-hmm.
And I got a taste of cash flow. It was $2,200 a month rent that I brought in, and the mortgage was $1,600. I knew nothing about rent to value ratios, primary, secondary markets. All I knew is it pocketed a few $100 at least every month. And to a young 20-something-year-old kid, that was a lot of beer money back then.
Yeah.
And then it took me like a few days to realize, dang, this is something I can like rinse, wash, repeat on, and then quit my day job doing.
Now, how do you then go? And we'll come back onto the point you just made in a minute about the not necessarily buying your house as being the good investment, because I think we get drummed into us that it is. But I guess the first question I have is that, and how do you, when you realize that this is something that you would be interested in, how do you then progress from having that one? Because I think that's a big question that for a lot of people that are in that position.
Yeah, so I started to get sophisticated. I started to listen to all the free podcasts and read some books on the topics. Learn a lot about the fundamentals that buying the first one I just didn't know about.
Yeah.
It's funny, I didn't really read that silly Rich Dad Poor Dad book that a lot of people have read for years later. And when I did, I was like, oh yeah, I'm doing this stuff in the other. I know this stuff, right? This is like
It's too
not
late.
a
Yeah.
little too late. Oh, this guy, this guy's talking the right stuff right here,
Yeah.
But I mean, it was just I got that bug and I saw that path forward. And being an engineer, you're able to make a spreadsheet and just kind of do the numbers and make a plan. And that plan was very attainable. I realized that, it wasn't going to be a super get rich quick type of scheme,
Mhm.
and it was going to be very slow in the beginning because, when you put down money on these properties, I was doing it the slow way, just normal traditional 20% down payment down. So I was limited to how much money I could save from my day job. And that was initially like my biggest thing. Like I was able to save money pretty good because I was pretty frugal. We grew up frugal, and I was able to save 50 grand at least every year from my paycheck.
Nice. Yeah.
And I kind of, as I got more and more motivated by this stuff, I tightened the belt even more. And started to live off the company dime on expenses all the time. I didn't rent anywhere for like 5, 7 years. And I was putting away like, I don't even know how much, like 50 to 100 grand every single year, just going to investments for the first 5 years.
Smart. And then how did you then evolve from there? Have you then, that you say you were doing it the slow way, did you start to change your approach?
Well, I think when you hear about real estate investing, you hear about like, the HGTV shows that like house flipping. It's very dramatic and entertaining.
Yeah,
I
of
will,
course. They got to get people to watch those things.
yeah, I don't do any of that. Like I've gotten called for one of those shows one time, and we kind of flip apartments, but it takes 3 to 5 years to do. And they're like, yeah, man, that's just boring. We don't got time for that. It's like, but that's, again, I'm a passive investor, right? All the stuff you see that's exciting, high risk, high reward is more active investing.
Yeah.
Passive investing is slow and it's more conservative, it's more prudent. Um, you buy things that cash flow on a month-to-month basis, and one of the ways is you ensure by buying properties that only meet like the 1% rent to value ratio. So rule number one of investing, says Buffett, is don't lose money, and you do that by making sure you cash flow every month, that the investment um, runs itself.
So talk a bit more about some of the principles then that you follow that have allowed you to be successful, and that someone else who's interested in getting into real estate investing could follow. What if you were, I often ask this question, if you were going back to the beginning and you were now your mentor, how would you guide somebody who was at the very beginning of their journey on this? What path would you tell them to take?
Yeah, I mean, there's a parts of this business that is kind of subjective, but for the most part, it's numbers driven. That's why I like it. It's takes the emotion out of it. One of the biggest things you could do, just sitting right there right now, I mean, guys can go on the websites and figure out what the price of the properties are, and also figure out, maybe, I don't know what you guys use, but Facebook Marketplace, Craigslist, how much it rents for. And you can kind of figure out what the rent to value ratio is. So we target things at least 1% or higher. So you take the monthly rental price
Mm-hmm.
and you divide it by the purchase price. So for example, I mean, we normally buy, like some of my students, they buy rental properties that are $100,000 that rent for at least $1,000 a month.
Mm-hmm.
So the 1,000 divided by 100 grand is 1%. That number sort of indicates that the rents that's being brought in will support the debt service and then some. Again, the magic number we try and shoot for is better than 1%. So a lot of people live in California, Washington State, Hawaii, New York, or possibly a lot of places where you're at, Europe and Asia. The rent to value ratios suck. I mean, this ain't gonna
Yeah,
work, buddy.
they do.
Unless you go out to like the ghetto or like the worst areas, like what we call Class D and Class C, it ain't gonna work, right? Like, I mean, you're in California, for example, you'd be lucky to find a $400,000 house, and that'll probably rent for 2 grand. So 2 grand divided by 400,000 is 0.5%.
Mm-hmm.
Ain't gonna work. So that's kind of the first thing. Like, you may not be around good properties or good market to invest in for cash flow. I mean, it might be good for appreciation, but maybe make me one thing clear. We do not really invest for appreciation. If it happens, it happens. It's icing on top of the cake. But primary focus is cash flow. And that's, I think, it's different from a lot of sophisticated investors go by this principle. It's different than what most investors do.
Yeah, I think there's definitely two strategies, right? There's, I think some people do go for the capital growth, and others go in purely for the cash flow. And we have the same thing over here in the UK. In some of the some areas of the UK where house prices are much lower, they're much better for cash flow. In the south, around London area, they're far more expensive, and doesn't work quite so well. Then you end up with other different tactics. What other principles have you applied when you first started? Where did you start investing? Was it near where you were living? Is it an area that you knew, or did you branch out straight away?
Yeah, so I started investing in Seattle, and that's where I lived, which again is not necessarily where the numbers make sense, but I didn't know any better, right? My first one. But the second principle is investing in places where we grade these properties in areas. So you want to be in a more B to C plus class of area. So we stay away from the two bookends. So the A class, like the luxury stuff, you're just not going to cash flow in those areas, and it's too pretty.
Yeah.
A lot of the unsophisticated investors and home buyers you're competing with, so you're not going to get the pricing on that. On the low end, like your more war zone area. I don't know if you guys have guns where people shoot each other like
No,
here in
thankfully
America.
we don't have many guns.
Yeah,
They're not
yeah.
they're not a thing over here,
Kind of
thankfully.
like katana blades in Japan, right? They don't have too many guns.
Exactly.
Yeah, yeah. Goofy here in America, right?
Yeah.
So on that low end, I mean, you can pick up properties for 50,000 bucks
Hmm.
that rents for $800. So if you're doing the math at home, that's well above 1.2%. It cash flows like crazy on paper, but shit, if that happens, like that ain't gonna happen, right? So there's a sweet spot, right? In the least amount of pain and suffering as a landlord, and like your numbers and a good quality product. And in America, the bell curve, most people live in class B, C housing
Hmm.
is sort of the medium. Um, so we kind of stay in the middle there, and then we kind of target more secondary, tertiary markets. So no primary gateway or coastal markets though. So no Seattle, no Los Angeles, Bay Area, Hawaii. I live here in Hawaii, great place to live, but the numbers don't make sense.
Hmm.
Places like, if people have heard of these, maybe a lot of you guys haven't heard of, like Birmingham, Atlanta, Indianapolis, Kansas City, Memphis, Little Rock, like places you guys would never visit. I don't care to visit other than to visit my properties, but like that's just where you get the good numbers, the cash flow, and they're less sexy markets. And part of the reason why is like you don't have all this unsophisticated money going there.
Hmm.
So for example, like Las Vegas is more of a secondary, tertiary market because it's just so freaking close to California and people go there all the time for vacation. You have a lot of unsophisticated money going to that particular market.
So you get a lot of people buying kind of vacation properties and stuff like that.
There's a lot of wannabe investors, right? They think that, oh, Las Vegas is a little bit off the map, but it's like that. You go to like the Mexican travel spot, right? And you think that you get off the beaten path, but everybody else and their mothers got the same idea, right? To get away from the
Exactly.
resort, like, and it's kind of the same idea.
It's like the phenomenon where everyone knows when the traffic's likely to be, so everyone leaves early to avoid the traffic. So
Right, right, and they just
everyone ends
pound
up
the other
traffic.
thoroughfares, right? Yeah.
So talking of that, then you're talking about like kind of investing across the states is a big landmass. How do you practically start to invest in such a large area?
Yeah, great question. I mean, we outsource it all to property management. Um, I own 4,200 units. Dude, I don't know how to change out a toilet. I don't know how to do an eviction.
How do you source them in the first place?
I mean, there's a lot of property managers out there. I mean, it's a
Mhm.
big industry, and you don't work with, whether it's a property manager, plumber, whatever. You don't work with them unless you have a good referral from somebody you trust. So this is where the relationships come into play. I mean, you can go on Yelp or whatever. You're probably gonna get not the best people. I mean, going to like a big brokerage house that they can do property management for you, but you're likely to get the dude who can't sell houses. I don't want that person doing a much harder job of like leasing my properties out and managing difficult people. You always want to go through referrals and everything you do. And this is where it's hard, right? Because
Yeah.
most people want the stuff spoon fed to them, but they don't want to talk to some other person to get a name. They just want to go in their underwear on the computer and like Google something
Well,
or
we've got
Yelp it
used
or
to
whatever.
it, right?
Oh,
We've
what's that?
we've got so used to doing everything through the screen now. You don't even have to speak to somebody to order food. You can do that through your phone and through.
Right, right. And that's what like, like crowdfunding websites are kind of the same thing. In my opinion, the
Yeah.
deals on the crowdfunding websites are just for people who, the syndicators who couldn't fund their deal. I mean, I've tried to use them as a capital source, and they just charge us so much money that to me makes no sense unless you're super desperate as an operator, why you'd use one of those crowdfunding websites. So I think it's inferior investments on there.
Mm.
But heck, I mean, they get that dude who just wants to play on his computer in his underwear and he wants to invest his money, right? Like, but I think as an investor, there's always like a minimum effective dose to anything. And investing, if you just connect with a few people, get some referrals, you'll do heck of a lot better than the average Joe in his underwear.
Yeah. And when you were in the early days, you're sourcing the properties, the actual the real estate itself. Did you fly? Were you flying all over the place to view these things, or did you quite quickly trust somebody else to give you the information you needed?
Yeah, so my first few units I bought in Seattle, but then I went a few thousand miles away. I don't even know who cares how far it was. It wasn't where I lived.
A
I
long way.
bought I bought 5 in Atlanta, 4 in Birmingham, 1 in Indianapolis. It was kind of my initial before
Mhm.
2015. I didn't visit them. I just got worked with the right brokers and property managers off referral, and I kind of just trusted and went. And this is where like a lot of my friends are like, "That's crazy, man! Like, how do you do this?" And this is where I kind of started my podcast and kind of told how I did this tactfully back then, because a lot of it's I forgot about. So a lot of this is like the first dozen podcasts and like how I did this,
Mhm.
because my strategy has kind of changed. I'm going after more apartments these days, but for newer investors, I think it's pretty. I always kind of refer them to this, the tactual tips that I did in the beginning, because it is crazy, right? I never visited these properties a lot. I mean, after a couple years and I was buying more, then yeah, I took a trip out there, but when you're cash flowing on one property a few $1,000s a year, taking a trip out there, and more importantly, like most of my clients are high net worth,
Mhm.
high paid professionals that only have maybe 2 weeks of vacation. It ain't worth it to go burn a few days to go to Birmingham. It's not a
Burn
good
the
use of
cash and the
time.
time. Yeah.
Yeah. Yeah. I mean, let alone the flight and hotel costing $1,000, right? But just time more important than money to most people, some
Yeah.
people.
It should be to most of us, to be honest. But and I think we put a lot of prominence on the cash
Yeah.
side of things more than the time.
Well, it thankfully that's the way, right? Because for some of us who value our time and front more money, there's plenty of people out there driving Uber and Lyft and
Hmm.
delivering my food that think otherwise. So
It's a good point.
yeah, I mean, these days, I mean, you start to think intellectually about time and money. I mean, money you can generate, but time is something you cannot, and you can trade money for time. You can pay for quickness, but you can't do it the other way.
Yeah, wise words. So you just said there you kind of you work more with apartments now than houses. What was it that made you kind of change to that strategy? Are you talking like whole blocks of apartments?
Yeah, so today we kind of focus on 100 units and above because there's just more economies of scale. We don't compete with the mom and pop investor buying a, $1 to $3 million property,
Yeah.
and we get better lending when we go to these larger apartments. And then I want somebody who's in the office at all times and a handyman running around knocking out small work orders instead of paying third party repair bills. So, but I mean, it wasn't always like that. I had to get my net worth up to a certain level to be able to make that jump to the big stuff. And I would say, somewhere between $500,000 net worth is kind of the point where I'd say most people should jump up to the bigger stuff. Certainly, if you're an accredited investor, I'd say syndications and private placements are the way to go. But I mean, I thought single family homes was going to get me to the promised land, and it can. But when I had 11 rentals, I realized that I had some kind of big catastrophe that happened every quarter, like a plumbing repair, a tree falling on the house, and it's some kind of eviction every other year or every 6 months,
Mm-hmm.
just on 11 rentals, which is no problem again, right? Because I'm having third party property management deal with all my garbage issues.
Yeah.
Um, it was not too bad, but
But
you're still playing the manager role.
yeah, so it's still something that's still filling your headspace, and also it still hits the returns, right? So
Yeah, and with 11 rentals, I mean, if you do the math, a few $100 per property, you're talking about what, $3,000 a month, which, hey, I'm not complaining, man. Not It's first world problems,
yeah,
for
true.
sure. But what person can retire on $3,000 a month? What family can do that? No, you need three times that
Yeah.
amount. So three times the problems, right? And then I started to join different masterminds and started to network with other high paid doctors, lawyers, engineers that were a little further along the line as me. And it opened my eyes because the tune of their story was, yeah, we all owned rental property at one point. And it's great when your net worth is lower. But for more accredited investors, it's investing in private placements and syndications and completely scalable investment vehicles. And but a lot of it is predicated on building your network because you have to go find people to invest with.
So you're finding other people that to basically form syndicates with to be able to then create the economies of scale.
Right, right. And you're trying to, work with different operating partners because there's always the analogy that we like to use for these syndications, it's like an airplane. An airplane has the cockpit of the general partners, the people who find the deal, they get the lending in their name. So none of the passive investors get any lending in their name, no debt in their name. They operate it, they pay out all the distributions, and then all the passive investors come and coach, pay their money, and they sit down and they go to sleep and they cash your checks. And the passive investors are in, a few dozen deals. So you're diversified over different partners, different asset classes, apartments, mobile home parks, self-storage, assisted living, developments, and then also, geographically, you're all over the place too. I mean, this, and then the tax advantage is so much stronger than owning little single family homes because you can do a cost segregation, extract out bonus depreciation. Might be more specific thing with America that we have these days, but I mean, this is how you pay little to no taxes, and this is how it all comes together, right? This is how the wealthy do things.
Yeah, talk a bit more about that because I know you talk a bit about some of the rules that the wealthy play by that um, most people don't know or even exist. Never mind know how to play them. So talk a bit more about some of those principles.
Yeah, I mean, obviously we're not like investing in any retirement accounts, right? So we're investing our cash for a variety of reasons. Like first of all, like I want my money. I'm retired now, technically. I still work, but like I want my money well before I'm 60, 70, right? But when you put money into a retirement account, it's locked up until then. Number two, I'm just speculating here that I'm probably going to make more money in the future than now. I feel like my future is bright. Trajectory is going up there, which is contrary to what they teach you, right? They teach you that you're going to make a lot less because your W-2, your salary is going to be going away
Mm-hmm.
and you're going to shrivel up and die and eat ramen noodles until you die. Um, so with that said, my tax bracket will likely jump up in the future. So I want to pay my taxes today while I'm in a lower tax bracket today. Thirdly, I mean, I don't know if you guys look across the pond, but like we spend money like crazy out here. Our government does, and how else are they going to pay for all this stuff but to raise taxes eventually? So taxes are going to be going up in the future. I would rather pay my taxes today, get it out, and as opposed to always continuously having this lien over my retirement accounts. Fourthly, which a lot of people don't realize is, like I said, we get a lot better tax benefits with these larger syndication deals. We pull out a lot of passive losses and hold them so that we can use it when we want. You don't get any of that when you invest via a retirement account. So, I mean, a lot of the sophisticated accredited money is getting out of those type of things. And if you look back in history, like we didn't have those retirement accounts set up before like the 1980s, around there was when it was kind of created. And it was kind of a program that was brought the big brokerages and the government in cahoots with each other to put stuff money into these mutual funds. On the one hand, I mean, I think it's good. Like people should save their money, right? But not necessarily in the clutches of all these Wall Street companies
Yeah,
that
exactly.
they've got it.
Yeah, I think everyone's got brainwashed into not having control over their money. It's give it to a money manager who it looks like they don't charge you a great deal, but
Right.
they're charging you 2%, and it ends up being a huge percentage of whatever gains, if any, you're making in the year. And I think people look at the number wrong.
Yeah, I mean the expense ratio may be 0.015, but that's not it. They're hiding a lot of above the line expenses in there. And it was made clear to me that, like, I mean, if people go to my website, I kind of break down like how much money do you make with some random average rental property, and it's can be like 20-30% at least per year. And I was like when this is very early on, I was like looking at that and I was like, well, how am I making 8% in my stock stuff? What the heck? What happened to all my money? And then you start to realize that this is a big engineered system to like extract all these fees out from everybody's hardworking energy. How else did they build these big buildings, right? How else did these pay for these like Cambridge graduates to go work for them and do analysis all day long? I mean, if you put in a little bit of effort and do it yourself, look what you can do this on your own, right? Yeah. Or if you kind of want to just get slaughtered like everybody else, you can do what they do and work for 50 to 60 years. And this is what angered me so much. I was like, this is unfair. There's a lot of hardworking, smart people that just blindly put their money into this system, but there's a crack in the system.
But the system is designed, like you say, to extract huge amounts of cash for the people running the system.
Right. I mean, what would happen if a few people from listening to this bought a rental property this year or next year, and then 2 years later saved up more money to buy another one and just kept on doing that for not 30 years, but just 10 years? They'd be financially free. And then they would stop doing all that random stuff, trading time for money, like, and this economy would crash, right? It can't happen, right? Like society cannot function if people did this.
That's an interesting thought. If everyone saw the game, then the game would be over. There'd have to be a different game. The game would have
Right. I mean, people are going to listen to this podcast, and probably only 5% are actually going to go listen to my first 8 podcasts to actually like learn tactfully how to do it. And then eventually those 5%, those motivated souls will eventually hit a wall and stop. That wall is kind of there to kind of filter people from doing this stuff. But it's not hard, right? If you have the right like connections and you kind of just persevere, like anything, like financial independence is not for everybody. If not, it wouldn't be for anybody. It wouldn't be there.
No, I think there's a lot of, it's the unknown, isn't it? Right? Lots of people we're scared of the unknown. It's kind of a bit of a human trait, and I think that tends to stop most people from going any further and investigating. Never mind starting. But I think, like you say, when you started, you kind of did your own thing, and then you found other people that were further along on the journey, and then learnt from them. And my advice in anything, if you want to do something different, is try and find someone who's a bit further along, and learn from that person or people. Join groups these days. You can join networking groups. Are on Facebook. They're all over the place. So you can find like-minded people probably easier than you could have done before all of this, when you had to go into an awkward room and stand there with your name card on and say,
Right, right.
no, right.
Yeah, exactly. I mean, it is kind of easier today, but
Mm.
there is a lot more noise out there. I think that's the hard thing.
That is the hard
To
thing. It's kind of that's probably a good question. It's kind of like, where do people start? Where do you try and get through that noise? Because I think marketing's very sophisticated now, and everybody
yeah.
wants some.
Facebook groups are just marketing tools these
Mostly,
days,
yeah.
right? Yeah.
Exactly.
And you know, that's like everybody's making podcasts these days because they're really effective. But so now your podcast like directory is just loaded with a bunch of garbage. But
And it's hard to even have the time to listen to everything that you want to listen to, or watch everything you want to watch, or read everything you want to read. There is so much out there, and I think the trick is to really focus in on kind of like one or two things at any given time, and really focus in on those things and learn whatever that one thing or two things are to a certain point, and then move. I think we get distracted very easily on trying to learn a million things at once. I've definitely
yeah,
fallen into that trap at some point.
I mean, and so what I see a lot of people doing it, or what I recommend is like, absorb all the free stuff for about 6 months and just be a sponge, right? Get that baseline level of knowledge so you can intelligently hold a conversation, even though you may not have any experience. And then I would say after 6 months, like get off of the podcast, the free content stage, and really mix it up with people actually doing it. I think that's an important stage because you fall into that mistake of, and you see them out there, the guys listening to podcasts for 2, 3, 4, 5 years. They know everybody, but they don't have done anything, right? The
Hmm.
podcast junkies. And then like, because my clients are usually high paid doctors, lawyers, engineers. They're more accredited investors. That's something I always tell them is like, avoid the local RIAs, even though that's traditionally said to place to be going for real estate networking, and avoid, those free websites, the blogs, and the forums. And I tell them that because I say you got to find your tribe, the people of your pedigree. A lot of people, they think of real estate as wholesaling houses, flipping, the active stuff, as we mentioned
Hmm.
earlier. That's not what passive investors do, and that's just not the place that a higher net worth accredited investor would hang out. They're not going to go to a free happy hour and hang out with some bros, drink some beers, right? They may very well like that, but they're not going to go hang out with guys much lower net worth than them because those guys are doing different things. They're more active. They're trading their time for money, whereas the passive investor is much different. So I always tell people like, sorry, I can't really help you out where to go, but I can tell you where not to go. And yeah, don't go to those places.
And how do you? Because I guess one of the things that for a lot of people is they think, well, it's an imposter syndrome type thing, right? You don't if you feel like you're not at the same level as somebody else, how do you kind of get involved in those circles where you really need to get to with people that are further along?
Yeah, I mean, that's a hard one, right? I'm kind of in my head, I'm thinking of like, a young dentist, right, making a lot of money. He's definitely shouldn't be doing flipping houses because that's a lot of effort and risk and bad tax wise. But where does he find these other people? I mean, I don't know, man. It's hard. I don't know what to say. I mean, I have my tribe, and that's why I've created my tribe, right? Not to like pitch anything, but that's why it's so freaking valuable, right? How else are you gonna find other high net worth investors that you want to emulate? Um, Yeah, I mean, I think you have to figure, and then how do you figure out what you want to? I think that's where the first 6 months comes in.
Yes.
Go in there and sample everything in the cafeteria, and but go in knowing with the lens like where you should fall, right? Like if you're higher net worth, you make a good salary, you're more of a passive investor than an active investor, and kind of start to specialize more in that area in a way.
It's good.
At least know what you want.
Yeah, and I think well, that's a fundamental for life, full stop. And I think probably a step that most of us skip at some point. And we got to, if you don't know what you want, you don't know what kind of lifestyle you're after. You may want to be busy doing, doing real estate, or you may want to be more passive. It's you got to know what kind of lifestyle you're after.
Yeah, but it's hard, right? Like, I mean, I'm just thinking of like something as daunting as going to college and picking your degree and picking your path in your career in life. I mean,
So
what a
early on,
daunting
yeah.
thing. Maybe like the missing ingredient is that mentor that kind of knows you and knows a little bit of the landscape to point you in the right
Yeah.
direction. So like, I mean, this happens a lot. Like a younger guy who's broke, you know, net worth $100,000 or less, and he's just starting out in life, right? But he reads all the stuff that apartment investing is better, and it is better, right? Syndication is better, right? But they contact me, they find me through my website, and they're like, yeah, I want to do this. And I'm like, dude, you're broke. You gotta be more active investor, right? This is more for rich people,
Yeah.
right? Like yeah, you followed the breadcrumbs, but that's not your pedigree, but if you had somebody, I mean, I guess that's the role that I do. I mean, I have free, like really quick 15-minute like onboarding calls where I kind of just point in people in the right direction for, other than, I figure if I can spend 15 minutes of my life helping out random strangers, that it would save that particular person dozens of hours, right? Screwing around doing syndications when really they had no money, no shot, and they should
Yeah.
just buy their first rental property, right? They kind of just, you go here,
Go and
right?
earn the stripes a bit. Go and get to know the business. Go and get to know
Yeah.
real estate a
Or
bit.
just saving their time, right? Their time and
Mm.
energy and focus to not focus on something that's just eons away,
Yeah.
that they
Yeah.
haven't hit that stage yet.
Got to work your way up. Um,
Right.
who do you think's probably been the biggest inspiration or influence on you since you started doing what you're doing?
Um, I'm not a big like guru guy, or I mean, I like Tony Robbins. I think he has a lot of good stuff. But I kind of sample from a lot of people. Gary Vaynerchuk is another
Hmm.
guy, but I stopped. I mean, I notice a lot of people, they really spend a lot of time consuming all those guys' content, but I kind of try and stay away from it. Like, there's two people in life. There's people who create content, and there's people who consume it. I try and stay on the side of creating my own stuff.
The same with products, right? There's the magic formula is if you want to get rich, create, and if you want to be poor, consume. And the bulk of the population is in the consumer market.
All right. I mean, just like, your social media feed, right? Are you want reading everything, or are you want creating it?
Yeah, very wise. What about books? Well, if you could recommend a book, a single book, what would it be?
I'm not a big fan of books. Again, I think more can be found of actually doing it and experiencing things
Mm.
and screwing it up. But I mean, I like, for real estate investing, Millionaire Real Estate Investor by Gary Keller has a lot of good fundamentals. And after that book, I mean, like, dude, you should just go out and buy a property, right? That you're gonna learn a lot more of that stuff. I follow the 70-20-10 rule, which is 70% is doing it, 20% is learning through your peers or a mentor, but only 10% is the academic stuff, reading these damn books. Right? I mean, I think they're great for mindset if you're kind of getting stuck,
Hmm.
motivation wise. But I think too often most people, they get stuck on this self-help type of syndrome where they're just reading books and then it's kicking off the endorphins that they're making progress when really they're not, right?
Yeah, you don't go forwards at all, and it's very easy because there's so much good marketing around that stuff. Like I said before.
Yeah, I mean, if it's working for you and it's getting the results, because yeah, I'll admit, like, days are long, right, as an entrepreneur, and sometimes you need that little perspective change.
Yeah.
So I'm always reading stuff, but like kind of quietly as this always on the back burner.
I find it useful for if you want to, if there's a particular skill to get the theory part right. So you go, well, actually, and rather than just aimlessly reading theoretical stuff, like if there's it's like you would like if you were going to do another college degree or something, right? There's reading involved, and if you want to find right, there's a skill that I need to develop, let me learn a bit about that, and then I can go and apply the stuff that I'm reading. Then I think it's useful. But it's very easy to fall into the trap of just read, and never do.
Right. And it kind of falls into like the whole imposter syndrome, right? You don't think you're ready, you still think you need to learn, incubate. But I don't know. Stop being a weenie, get out and do it. Make some mistakes, have some confidence that you can recover. Right.
Like it.
I mean, never do anything that you cannot. You always think, what's the worst that can happen?
Mm-hmm.
If you can't recover from it, then don't do it. Right. So you always should be taking small calculated risks that you can, if the worst happened, you can recover from.
Yeah.
Right. Like I don't go skydiving because the worst could happen, I die. But I'm gonna put 20, 50 grand into this investment, right? Small incremental investments or risks, and it's something I can live with.
I'm with you. I don't skydive either. I'm one of those people that every time every time I buy something, it seems to be faulty. So I'm not going to risk it with a parachute. There's not a chance. How do you start and end your day? Do you have routines at all?
I get up, I check the emails for a couple hours. I know that's everybody says not to do, but hey man, I gotta put out the fires and I gotta,
Mm-hmm.
talk to investors. And then yeah, just putting out fires for the next few hours.
I bet it must
That's
be quite interesting because you're being in Hawaii. You're kind of behind the time zones for everywhere that you're working with, I assume.
Yeah, and that's part of it, right? Like when I wake up, my colleagues in Texas are already at lunchtime, and they already put up a whole bunch of junk in my inbox at that point. It kind of cools down around the afternoon here, so I can kind of work on my projects, but I am more tired. So
Mm-hmm.
it kind of bucks the whole like theory of like eating your frog, getting your big projects done first. And but I don't do that. I don't sit down for 15 minutes and meditate about my big goals in the morning. I don't do that, right? Like I just don't do it. I don't have time for that is what I feel like. But yeah, well, I guess what I'm saying is like whatever works for you, right? There's
Exactly.
no
And that's why I asked that question because it is different for everybody. And there's always you've got to get up at 5 a.m. and you've got to do this and you've got to do that. And the point of having these conversations is to say, actually, lots of people do things in different ways. Maybe something that you do, something that someone else does is of interest to somebody listening right now and says, well, I could try that, right? And see if that
yeah.
works for me.
I think the big thing is just like do you, but make sure you're executing, right? Like if
Yeah.
if it's not working for you, then switch it up. But like I think you hear, especially a lot of podcasts and what you hear on YouTube is a lot of self-selecting bias
Yes.
advice, right? Just because Mr. Timothy Ferris does something one way doesn't mean that you should, right? Or he interviews 5 super successful people. Well, maybe you shouldn't do that because those are the outliers, right?
Yeah.
I'm not gonna follow like I don't know, like LeBron James's eating habits for some reason because I'm not freaking LeBron James, right? Like, that guy's a freaking alien,
This
right?
is true.
You know,
Yeah, if you're not a professional athlete, you don't need to live like one.
right? Or I mean, I just might be different, right? I'm just wired differently, right? And just because I think my argument is like these guys that you hear about that have these big influences, they're aliens. They're not humans, right? What the heck are you? Most likely, if you're listening, you are a human, just like me. Why are you gonna go follow their advice, right? Like, it's like Michael Jordan's guide to basketball. It's like, oh, just dunk the ball from the free throw line. All right, man, got that, right? Like, that's just not good advice. It's a paradigm.
Hmm. Yeah, it's true. They are. It's interesting because it tends to be the outliers that end up having the loudest voice, and so the masses try and be the outliers, and it becomes, I think, it becomes tiring, right, and
Yeah.
disheartening because it's hard to keep up with that kind of
I
stuff.
I want to know what the guy who sucked got the most out of his suckness. I want to know what that guy did,
Yes.
right? I want to know what the 300-pound guy did to lose 20 pounds. I want to know what he did, right? But there's never that. Let me know when you find that podcast or whatever. But that's just not going, that just doesn't get any airtime, right?
Well, it's because it's not the shiny, sparkly thing with the huge budget.
Yeah, I don't want to hear what is Tim Ferriss's book, like Legends or
Well,
something like that.
the Tools of
Giants.
Titans.
Yeah, I want to know what the tools of the scrubs out there are, right? The scrubs that found a little glimpse of success or whatever it is.
I
I
like
want
that.
to know what that is.
We should write that book.
We just went out and we just found the losers out there that had that 1 or good 2 weeks, and we figured out what that was. So
Someone had
we
a
could
great
emulate that. We could emulate that for 2 weeks, and we could just string along with maybe a few of those for a month.
I love it. Where can people find you? Where can come and if they want to find out a bit more? If they're along the journey, they're somewhere in the vicinity of investing at the level that you're at, or want to know a bit more. Where can they find you?
Yeah, so my podcast is Simple Passive Cashflow. The URL is simplepassivecashflow.com. So we kind of cater to more of accredited investors, high paid working professionals. But I'll say if you're starting out, the first, I would say, dozen podcasts would be good to listen to. They were more about buying single family homes, just getting started, remote rentals initially. Obviously, as my story has kind of progressed these last couple of years, it's gone more to apartment investing, syndication investing, and then infinite banking is another concept we talk about, and just more focus on like higher net worth accredited investors.
Lane, thank you very much for giving up your morning, nice and early.
Yeah, thanks for having me, David.
Bet your weather's
Appreciate
way
it.
better than mine is. And for anyone who's listening now, like I say, there'll be links at pocketmastermind.com. Head over there and you'll be able to connect with Lane. And until next time, thank you very much for listening. Thank you so much for listening to this conversation. If you enjoyed it and you'd like to hear more similar episodes, head over to pocketmastermind.com, where you'll also find the links mentioned in this conversation. And if you haven't done so already, please leave us a review. It will really help us to get our message out and let more people know about these episodes. So leave us a review, leave us a rating, hit the subscribe button, and please share with your friends. Until next time, thank you again for listening.